My background somehow got inversed.
It looks right on the screen. When we see you, we see it right.
Oh, you do?
Yeah.
Yep.
Huh. That's odd. On mine, it's flipped.
Yeah, it looks
Yeah.
backwards.
Yeah. But when we see you, it's normal.
All right, good.
It's the magic of how all of these things work. So yeah.
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 Dan, you said yours is the same way on your screen?
Yeah, but yours looks right on my screen. So are we ready to get started here, or?
We are ready to go.
Looks like we still have some participants rolling in, so we'll give just another second here. Yeah, it's nice to be surrounded by the great sponsors here.
Yes.
It is, yeah. It's also an excuse so no one has to see, my office, right? my poorly decorated office. Right?
There you go.
Not like
Emily's
Steve's.
is clean, so I think.
That's right. It's
Mine look like
digitally
that, show it
clean,
off
which is
too.
even better.
Yeah. Well, I guess, we can kind of kick off and maybe get some of the housekeeping items out of the way while people are still rolling in. So I'm Dan Capella, member of the program planning committee at ACG Detroit. Just wanted to, kind of kick this off just by thanking everyone for joining us today and continued support of the ACG Detroit chapter, and looking forward to a great discussion on preparing business for sale. This is our first program in the Driving Business Value series. And for those of you unfamiliar with the Driving Business Value series, it's a subset of the ACG programming that focuses on introducing business owners and their advisors to topics outside of the day-to-day activities of running a business. So it kind of gives them a window into some of the areas that our ACG Detroit chapter members specialize in as service providers. I think everyone familiar with the series has really been missing the great content from the lunch and learns that we had over the years. And, want to give a shout out to one of our panelists here, Steve, who did a great job leading this series over the years, and really looking forward to getting back at some point here to those in-person meetings and those lunch and learns and seeing those panels live. But today we're excited to join you virtually here. And I think we got a great topic and a great panel pulled together. So, as you're probably familiar with at this point, attendees, you'll be muted during the event. Please use the chat feature, the Q&A, to ask any questions. We're going to be keeping an eye on it and trying to weave those in throughout the conversation. We're going to try to keep this a little bit informal, bounce around and make sure that we hit on those as we go through. And then at the end, kind of wrap up and make sure if we've missed anything that we get any questions addressed. So really, if there's anything along the way that you're curious about or want to follow up on, feel free to shoot that through one of those two channels, and we'll make sure if it doesn't get answered today, that we have somebody that follows up with you and you get in touch with kind of the right expert on that front. Of course, ACG's great programming is only possible with the help of the many sponsors that we have, and we really can't thank them enough. We'll start with our gold sponsors: Cohen & Company, Daudeman, Dykema, Huron Capital, Jaffe, JP Morgan Chase, Plant Moran. Silver sponsors: BDO, Butts Along, Clayton McCurvey, Connection Builders, Dickinson Wright, Howard & Howard, Huntington Bank, Cott Sangster, McDonald Hopkins, Purple Squirrel, Raymond, Schlaupitz, Matt Evan, UHY, Williams, Radner and Plunkett, and along with our media partner, D-Business, and all of our bronze sponsors. Really, especially as kind of the virtual setup keeps rolling along here, really thankful for the sponsors, and we can't do what we do without them. So a lot of information is out there on the ACG website related to sponsors, and also I think there's links to the individual sponsors' websites where you can find out more about those companies. So kicking off here, I took a spin through the list of attendees, and it looks like we've got a very diverse background, some that might be more familiar with the M&A process, and some that might be less, and some business owners and CPAs, attorneys. It's a great kind of group that I think we have attending today. So given our time constraints, we're probably going to move pretty quickly through some of this content. But by all means, feel free to reach out or raise your hand with any questions, and we'll try to address those. And if there's any follow-up, feel free to reach out either to myself or any of the panelists, and we'll make sure that we dive deeper if there's any further follow-up questions that you might have. With that, we'll do a brief introduction here of our esteemed panel of experts. We'll start with Emily Murphy from Plante Moran. So she's a tax partner in our National Tax Office. For those of you not familiar with Plante Moran, we're a public accounting firm with 20 offices across the Great Lakes and Rocky Mountain regions and internationally. Emily consults with our client base across many areas of tax, and she certainly holds a special place in her heart for M&A consulting and working with that privately held business owner and helping them through navigate the complex landscape that is tax. Next, we got Steve Savoy. Steve's the president of Savoy Consulting, an operations and consulting company based in Troy, Michigan. He's focused on improving operational performance of middle market manufacturing companies and interim management roles. Steve works with private equity companies to improve the performance of their portfolio companies. And next we have Dustin Hill. Dustin's a director with PHINIA, an investment bank located in Birmingham, Michigan, with offices in Chicago and South Bend. He primarily focuses on sell-side mergers and acquisitions for businesses in the range of 20 to 500 million of revenue. Dustin often begins conversations with sell-side clients years in advance and advises them how to maximize their outcome when the time does come to sell their business. And as your moderator, Dan Capella here, I'm on this webinar because Dustin's first choice bailed on him, and I happened to be on the phone when he did. So, happy to join you. But valuation expert at Plante Moran, we help privately held business owners and private equity firms with valuation issues that pop up for a variety of different reasons. My favorite engagements usually center around kind of this topic and getting a family held business over the hurdles that valuation tends to present in an M&A context. I think that we've got a lot of content to cover here, but what we're really hoping in our discussions and planning this event is that there's going to be some tangible takeaways. We're going to try to move this conversation kind of over the arc of a business owner thinking through a possible sale. So going from 5, 7, 10 years in advance through a closer time frame, maybe 1 to 3 years out, through the nitty gritty of the actual transaction. And so, I think to kind of kick it off here with a pretty high level question, when do you start thinking about future strategies for a sale? And Dustin, maybe it makes sense for you to jump in here and kind of give your perspective on when do you think, when is a good time for a business owner to start planning for a potential exit event?
Yeah, so I think the quick answer is the earlier the better, right? The earlier on you can, the amount of strategies that are available to you is obviously, much greater, right? But the good news is that there are things you can do along the full continuum, whether, 1 month, 1 year, 10 years in advance, that can help you in the sale process, right? So, one of the most common things we see, with our clients is, they have a very concentrated, base of customers, right? And there's a reason for that. A lot of business owners, don't want to have, 25 different customers, they want to have 4. It's a lot easier to manage. You can manage those really well. You have 4 really good customers, and that's great, right? And if they wanted to continue to run the business, it's probably a good thing for them. Well, if you're very early in the game, fixing that kind of, issue for investors, right? Because they're going to want to see a diversified set of customers, right? So if you very early in the game, you can change, that dynamic in many different ways. You can go out and pursue new customers. You can try to sell less to your current customers. There's a whole plethora of strategies, available to you. But let's say you're, only 1 month or 1 year in advance, right? The good news is that there are still things you can do even late in the game, right? And even on that same issue, right? So sticking with customer concentration. So maybe instead of your strategy being, well, let's go out and find a whole bunch of new customers to diversify my base of customers. Maybe I try to prove, well, this is my largest customer, but they're not my most profitable, right? I'm really diversified from a profitability perspective. So let me spend some time and try to figure out, how do I track costs by customers? How do I demonstrate that to somebody? And well, you may see 40%, customer concentration, between my, or, for my biggest customer. Well, they only make up 20% of my profitability, right? So from an investor's perspective, what they're really worried about is pricing the risk and the cash flow associated with that. So the cash flow is not tied up in the customers like it may appear on the surface. So, that's something you can kind of do late in the game that could really help you, demonstrate that customer concentration isn't that big of an issue. Some other things could be maybe you formalize a long-term agreement with them, right? You got to be careful with that one because it's got to be a favorable agreement. But there are things like that even on the same issue, you can do late in the game. And you can also do things very early in the game. So the general or quick answer to your question is earlier in the game, the better, right? Because the whole toolkit's available to you. But just because you decide I want to sell my business in 6 months, there are still things you can do within that 6-month period that can make a big difference. So.
Yeah, no, that sounds great. And Steve, maybe kick it over to you. One of the topics we were discussing in our kind of pre-webinar calls, and dovetailing from where Dustin was going is around risk. And from your perspective, how do you kind of address some of those risks and in the planning phase when you've got a little bit of time ahead of you?
Yeah, I think, Stan. So from my perspective, I typically see things on it has just been bought perspective. And so I see it kind of with the new ownership in the private equity companies is where I get a lot of my kind of perspective into this. And, when I think about private equity companies, they have the investment hypothesis and kind of the playbook that goes along with how they're going to make value out of this company they just bought, right? What's going to make it more valuable during their holding time. And I think about the improvements that private equity makes really kind of in 5 areas, right? And one of them is the thing that Dustin talked about, revenue. Is revenue growing? And then diversification of customers within an industry, and then also diversifying outside of a particular industry, right? So for example, if you are a stamping company and you've had great business, supplying tier 1s into Ford Motor Company, for example, here, I think one of the things would be great, of course, is to start selling things into GM and to Honda and Toyota. It would be great kind of within that. But then also it would be great to kind of look outside of, automotive specifically, and maybe look in some defense industry things or agricultural products, and Caterpillar and other kinds of companies become customers of yours as well, and look outside of the automotive thing. And this gives you kind of the industry diversification in your customer base, and it gives you kind of less risk to the revenue of the company. And it makes for kind of greater value on that side of things. And then obviously the second part that we look at for improvement, where I spend a lot of my time, is on the operational excellence side. What does it take to become operationally efficient? Are you, aggressively managing your supply base? How are you doing with your sales and operations planning, inventory management, shop floor quality issues? Are these things kind of best in class? Where do you kind of rest with these things? And typically, roughly as an example, a good supply chain project on purchasing, depending on how diligent a company has been, and this isn't even like huge companies, we can reduce very quickly, your raw material costs 15 to 25%, depending on how diligent you already are, in those negotiations. And that also includes some of your, non-production materials, services and things like that as well, right? So, and then the third part of that is talent management. What is the team you have in place? What are the skills of the people that are there? What are the skills that you need to bring in? Obviously the owners of these private equity companies do not, even though they're the buyers, they themselves don't sit every day and run those companies. They bring in teams to do that. And these are things that make, so you think of it as less work for the buyer if you already have people in place, a good COO, a good VP of sales person, right? A good finance person, CFO person. If these people are very high quality and doing a good job of these things, it takes that risk off of the table in terms of talent and effort for the future buyers to kind of realize value in there. Quality financial information. This is, again, a little bit of what Dustin talked about. How do you know the profitability of each of your customers, each of your product lines, each of your plants? Can you kind of get some resolution and details in terms of what's working and what's not working? Do you understand what are some of the first things that you'll see in the data when things start to go wrong? And are you doing things in a standard way? And obviously accountants and advisors can help with those kinds of things a lot. And then the last part of it is, we'll just call it kind of general governance, right? Which is a little bit of operational roles and responsibilities. Do you have to make every decision in your company, or do you have a team that can make some of those decisions and take some of that burden off of your plate so you're not deciding everything every day? And to Dustin's point also, the longer you can start thinking about these things in advance, the easier it is to do. And I think about it in the sense of, a lot of these things aren't just good for making a sale, it's just good for business, period, right? It's just, it helps the business grow, it helps you thrive, it gives you kind of ways to kind of know and mark your own progress as far as improving the company. So I think those are some of the key things that I think about when I start looking at and talking to owners who are getting ready to sell their businesses. I kind of use the very same rubrics that we use on the private equity and delivering value to their portfolio companies. A lot of that same work can be done by the owners ahead of time. Obviously, private equity is great. They bring in some capital, which gives some capital investment stuff that you can kind of move and grow into some new areas, and some of the acquisitive revenue growth, and kind of fill in some of those gaps there. So there's a great use of kind of, that capital to do wonderful things. But at the same time, there's a lot of things that you can kind of DIY, within your own company as you get there to be in a better place.
Yeah, and so when I think of putting myself in the business owner's shoes, our head of consulting, Dennis Graham, talks a lot about dealing with the tyranny of the now, right? So you've got a business to run, and you're trying to kind of scramble and service your customers and stay ahead of profitability and all those things. How do you carve out time as a business owner to focus on these, and how much time should you dedicate? And is it strategic planning meetings or working with your advisors? I guess, how do you start wrapping your head around things that, maybe on the surface you kind of know you should be doing, but are just really difficult to find the time and the resources to implement?
Yeah, that's a great question, Dan, and a super common theme, as you said. I think part of it is, recognizing that first kind of moment of just self-reflection and recognizing that, as the leader of this company, is my time being spent doing some of the minutiae that I really shouldn't be doing? Like, what is wrong with how I'm delegating? What is wrong with, are objectives not clear enough? Why are all these issues surfacing to me? I guess is one of the first questions you have to ask yourself, is in terms of getting, like you said, you can't start solving big problems until you get these small problems fixed. And the first step to that is like, why are these small problems even on my plate? Why am I engaged in this? Am I, as the owner, am I micromanaging? Am I having trouble letting go? Why am I having trouble letting go? And I think the hardest part for that is just recognizing that, I guess part of the benefit of these calls, right, as we have these conversations, is the awareness of, oh, it doesn't have to be that way. It's kind of, step one. And then, step two of that is, finding people that can help you with that. And I think most business owners have some advisors around them. And I think part of it is just asking that question, like, what do you think? How can I make this better? How can I not be so involved in the minutiae of stuff? Who can I talk to help with this? And there are a lot of kind of tools that are out there, for this. Super popular right now is, of course, the book Traction with the Entrepreneurial Operating System and the EOS framework, which is, a great kind of, business processes 101, kind of textbook and kind of lessons. It breaks things super simply. It's a great way to get started on stuff. So there's kind of a little, business processes for dummies, so to speak, kind of that 101 DIY kit that's there. And of course, there are consultants and advisors that can come in and you can talk to, and you know, and they've done projects like this, like we've done projects like this, like lots of times, right? So it's, you know, a lot of experience and background across a lot of different industries to kind of start getting out of the weeds and elevating the conversation a little bit. And then of course, once you get out of the weeds on a day-to-day basis, it becomes easier and easier to start thinking more strategically and enacting some of these strategic things we're talking about today.
And I think one of the important things to understand, like, you know, this isn't a, you know, I want to sell my business, I should go down path A in terms of my strategy, or I want to hold my business and go down path B, right? They're very much the same path, right? Maybe there's some distinctions, you know, certainly, but you know, there's a reason that thinking about your business through the lens of M&A or a future investor is valuable to you in the way that you run your business, right? So, you know, when you go out to an investor universe, the more people that are interested in your business, there's a reason for that. And it's because a lot of those investors spend a lot of time understanding what makes businesses successful, right? And so the more investors that you have available to you, it's simple economics, right? It's supply demand. If there's a greater supply of investors who like your business, your price will go up and your value will go up. And there's a reason for that. And that reason is because you've built a business that can withstand downturns, withstand, you know, all sorts of, you know, things that get thrown at you, and will ultimately be positioned for success in the future. And so, you know, as a business owner, you might run your business a certain way, and that's great, but you only have, you know, a limited set of experiences. So, you know, there is some value to be thinking about your business through the lens of valuation, even if you're not considering a sale, because all those investors have reasons for their rationale, right?
Definitely. Yeah, and you know, along those lines of carving out time to take care of some house cleaning, operations improvement, you know, Emily, what are kind of on the tax side? So obviously, business owners, entrepreneurs are always concerned about tax impact and what that means for their pocketbook. But you know, as you're thinking of the time horizon here, and you're a little bit further out, what are some tax kind of strategies where you can take a step back and say, all right, I'm meeting with my CPA and time to have some of the conversations around maybe cleaning up some of the strategies you see on your end that either, you know, tend to lead towards a successful exit or you know, can cause maybe some hiccups along the way.
Yeah, absolutely. So I think probably the one thing that you'd want to think about if you're maybe 5-7 years out from a transaction is your entity choice. So, you know, we could talk about entity choice for hours and hours. So I'll give the definitely the high level version. But, you know, I think like, especially if you're in a C corporation and you're thinking about exiting in 5 or 7 years, there might be some things to think about in terms of, is that the right structure for me? So one thing that might come into play there is when you sell the corporation, are you eligible for what's called Section 1202 or qualified small business stock? So if you have a corporation that's eligible for that, the sale of stock in that case can be exempt from taxation up to $10 million or 10 times your basis. But you know, a lot of your gain can be excludable in that category. So knowing that and kind of planning for that and protecting that status can be really important. Alternatively, sometimes we have like more, you know, closely held or family-owned businesses come to us that are C corporations because they have been for years, but they're thinking about selling in the not too distant future. And so at that point, you know, especially if they've got maybe a 5-year horizon, we'd think about, do you want to be an S corporation? And the advantage of being an S corporation is that as you make money, so if you make $1 million, that increases your basis in the stock, which either gives you the ability to either take money out of the business or when you sell it, you can kind of use it against the gain on sale. So those are things that, you know, are best kind of addressed up front. They're also both of those, both 1202 qualification or an S election, are things that you want to be very careful about to make sure you kind of dot the I's and cross the T's, because, you know, we're going to talk about diligence a little bit later, but those are the kinds of things that that kind of come up in diligence and that you don't want to have made some missteps that can cost you a lot on the back end.
No, definitely helpful. So, you know, if you're kind of transitioning from that, you know, 5 to 7 years, yeah, I'm thinking down the road and thinking through my estate, and maybe it's time to start establishing that horizon. You know, like, how do you go about assessing kind of the team that's around you? So you got your CPA, your attorney, and saying, all right, now my needs are changing as a business owner. Is there any, you know, kind of leading questions a business owner can ask their advisor to say, you know, maybe what's your experience with transaction, or I'm thinking about doing these conversions, is this the right entity for me, or how do you, start to put yourself in the best position as a business owner to get the wheels in motion there and start assessing your team that you've got around you?
Yep, I think especially as you get a little bit closer to a transaction, I think it can be very helpful to kind of start, like you said, to ask those questions of your advisor to say, how often do you guys deal with transactions? What are some strategies we should be thinking about? And if they kind of feel like someone who is maybe more involved in kind of supporting businesses as they are kind of continue to be owned, but less involved in transactions, it can be good to talk with maybe your attorney or some other colleagues that you have about kind of maybe referrals that they might have. And sometimes there can still be that place for that kind of long-standing CPA or advisor to kind of stay close with you because they've got that history. But then bringing in kind of somebody to supplement that it's a little bit more familiar with the M&A can kind of help with those tactics when you get kind of to go time.
Yeah, maybe Dustin or Steve, kind of similar question. How do you view that kind of transition from standalone, planning to hold this business indefinitely to now starting to think about, possibly looking at an exit strategy?
Yeah, I mean, I think on the team, right? I mean, there are some that are very obvious, right? I mean, at the end of the day, when you sell your business, the most important thing to you is, what's the cash I'm going to walk away with, right? So, well, tax is going to be a big part of that. I should have someone like Emily on my team, right? But some are less obvious, right? In the majority of cases, not every case, but a business that can operate with a management team independent of the owner, CEO, the more valuable it is, right? And of course, there's a buyer out there for everybody, and there's some people that seek a business that don't have a leader, that want to drop in their own guy and that type of thing. But generally speaking, and probably one of the most important takeaways for today is the more people who are interested in your business, the more valuable it is, right? So a less obvious kind of addition to your, your kind of team around yourself might be, a talent individual or an HR person or an executive coach or somebody that can help you find that management team or help you improve that management team, right? And make them a bona fide management team that you can actually present to people and pitch them on and get them to back, right? So, but the key theme, whether obvious or less obvious in terms of your team, that the key theme and a critical one is that your advisors have M&A experience. You wouldn't hire a psychiatrist to do brain surgery, right? I mean, they're both doctors, psychiatrists and brain surgeon, but it's completely different specialties, right? So even if you're looking at an attorney, right? I mean, you might have a corporate attorney, but if they don't have M&A experience, it's their own separate specialties. So the one key theme when you're thinking about your team that I would stress is that the business advisors that you do select have M&A experience, because it's its own animal, and you need somebody who can really help you navigate that.
No, I think that's great. And so now, as we kind of progress here closer to a potential exit event, and so now let's say we're kind of 1 to 3 years out, right? Probably too late to implement some of the strategies that we talked in the 5 to 10 year range, but still thinking about an exit event. Maybe you've gone through and kind of assessed strengths, weaknesses, some of the opportunities that are out there. Steve, what do you kind of view as some strategies that you can implement to say, all right, we want to make this business more marketable, knowing that we've got some issues that could potentially be out there. No business is perfect, and we want to kind of position ourselves to tell the best story to the market that we can.
Yeah, that's a great thing, Dan. And I think so when you get that close to thinking about sales, call it kind of that 1 to 2 year kind of horizon, at that point, you kind of know you're probably going to exit the business with a sale, right? And so you're thinking about, yeah, what do I need to do to get that done? And at that point, you do need advisors like Dustin talked about, and kind of Googling what do I need to do to sell my business a little bit, of course. So how all knowledge begins now. But I think one of the key things of that is just being aware of what's going to be required by the buyer. Buyers are, intensely curious and want to know all kinds of things about your business. And so, start processes of tracking machine maintenance and have the tag numbers and asset numbers of things. Keep track of, inventory. Don't just have shelves of stuff and you're not quite sure what's up there. Start valuing it, get rid of and write off already, expired and old inventory. And just the basic house cleaning stuff. Start talking to your suppliers about, this is a great time to start talking to suppliers about price reductions. You've got like a great history of stuff. Hopefully, just doing good business, you've been growing a little bit, and instead of buying $1 million worth of steel, you're now buying $2 million worth of steel. Great time to have a conversation about, hey, with my larger volumes, what kind of rebates do I qualify for? And make sure you're kind of getting all that on the table for stuff. Your MRO stuff as well is kind of make sure you're getting with those vendors. And maybe you can step up to a larger vendor pool, which gets better pricing for stuff with your larger kind of volumes that you're looking at things.
Yeah, no, I think that I want to circle back on a point that you had on capital equipment, because I do think that that's probably one that, a lot of our manufacturing client base deals with, and even on, maybe the tech side with R&D. But how do you assess, I'm staring down the horizon, maybe a potential sale here. I've got a decision to make. Do I spend cash now to build out and refurbish equipment, or do I kind of roll the dice in the transaction process and hope that maybe I can still get a similar valuation, knowing that my equipment might be a little bit older. Yeah, you got capital needs for this line of business. How do you kind of balance that investment analysis?
Yeah, well, I think there's kind of two pieces of that. One is, of course, the very pragmatic side on is there cash available to make the CapEx expenses, or is why you're seeking capital to make some of these CapEx expenses, right? And so, I think there's that very pragmatic piece of that equation. But of course, I think kind of when I talked about kind of the machine maintenance and keeping track of stuff, if you're acquiring new customers and they have new tolerances, and you're launching a new line of business, yeah, you got to make that investment. You have to buy that equipment kind of now, and recognize that the value of that equipment will not only be in kind of the actual physical value of it as an asset, but it's also, supporting evidence to your story that yes, we're growing this part of the business, and that new client and new customer, the revenue and profits of that customer have value as well in the business. And I think the more of this kind of detailed work that you can do up front, it makes it easier for Dustin and his team to kind of come in and tell a great story for the business. It's less disruptive when you kind of get into this sale process, because the information that the investment bankers and the buyers are looking for is kind of more accessible and at hand, and so it's less interruption for your management team and for you, and for the business in general. If it's part of your business practices to kind of get these things in place.
Yeah.
And so I think as much housekeeping and kind of cleaning up all the little messes and just getting the stuff out of the closets, right? And if you've been kind of on the table, under the table, kind of, profit sharing and doing some other stuff, let's get all of that kind of above, so we can have it as owner benefits kind of very cleanly in the financial documents. And people kind of know this is part of the profitability of your company. It's time to get all of that kind of stuff kind of cleaned up and move it away from being, this is great, it supports my family and we're really happy, to, this is something that I can now kind of show people, and I want them to be interested in and want this as something and want this for themselves.
Yeah, Steve, you just said something really important that was, that your CapEx spend and how you invest in the business has to be consistent with the story you're telling, right? So if you are a high growth business, right, and I've had clients, they're retail storefronts, right, and they're growing like crazy. Well, if you can prove that it's replicable, and let's say you drop $13.5 million into a new store. Well, if you do that and the store hasn't fully ramped up yet, you can get credit for that. If that's the story you're selling, we have a replicable model. We're growing. We can prove, that you can actually get a return on this. It's going to be a payback of this. Well, then you can get credit for that spend, right? But if you're, a business that's kind of, a little bit more of a, I don't want to call it an annuity, but you're not growing very quick. Well, the important thing is to, spend like you're maintaining your business, right? And that's what someone's going to expect. They're not going to expect you to, drop $10 million into a brand new line, 2 months before you sell the business, if you've never even, produced that product before, right? So there's kind of like this balance here, right? And investors aren't, they're sophisticated groups. We've had a client before that all of their equipment was very expensive and it was very dated, right? And so it was a very long process because it was a turnaround situation, tough to navigate and all that. But, they basically had, at close, we will have expected that you would have spent this much on your business, right? So we expect this year you'd have spent $6 million in CapEx. If you only spend 4, we're going to expect you to true up the purchase price by $2 million. So the people who are investing in business are going to be sophisticated around that, and actually spend the time to understand. Now, the most important thing, though, I think, is that you invest as if you're going to continue to own the business in the future, because no sale is guaranteed. No transactions guaranteed until the wires fly and the documents are signed. So if you were going to, just stop making investments in your business, well, what's going to happen post-close, right? So you really have to invest in your business as if you're going to own it, and the sale is not, a certainty. Right?
Yeah, and I think that's probably a good segue here into, as you're getting closer to close, and the sophisticated buyers and investors, and kind of the normal process that's in place in a lot of transaction nowadays, and just all the diligence that goes into making sure that a buyer doesn't miss anything. I think we've had whole, obviously ACG events focused on diligence and all the different, types of diligence that exist out there and all that. But,
It's a lot.
maybe Emily, I'll kick it over to you on the diligence side. And again, you got some time here, maybe a year or two, to kind of clean up your tax returns. You're meeting with your tax advisor. What are, kind of some of those questions, strategies that you say, hey, I'm thinking about selling here, and what can I do now to, really try to mitigate my tax exposure side if I do go through a business combination?
Yep, Dan. So I think you kind of hit it right, that I think that it is when you're maybe a year or two out from a sale, like that's a really good time to assess, where do I stand in terms of tax compliance and other areas of diligence, like you mentioned. But on the tax side, since that's the area I'm more familiar with, I think a lot of times as you're kind of running your business, there may be certain business decisions you make about not filing tax returns in certain areas. Like you didn't file in these 5 states because they were small, but but as you kind of continue on your business, and those kind of quote exposures stay out there for a little bit longer, they start to accumulate into maybe a larger pile of exposure. Similarly, if there's like state sales tax issues come up a lot on diligence. And that's a thing that, maybe you've been handling in-house. So your CPA and the people you're working with aren't even aware that maybe there are some kind of skeletons in that closet. So I think it's like when you are kind of maybe a year or two out, it's a good time to do like a nexus analysis to say, okay, are we filing in all the places that we should be? Having maybe your tax CPA doing a little bit of sell side diligence of saying like let's talk through what are the questions that a buyer is going to ask me, and figure out what those answers are. And if we do have anything that we want to get cleaned up, like let's do that now, so that we can say, we have these things, we've addressed them, and that the issues are off the table. I think kind of getting ahead of those, and kind of knowing that those, if there are issues that exist, tax wise or otherwise, those are likely going to get addressed in diligence, and it's better to be ahead of them than it is to be kind of behind the 8 ball.
Yeah, Emily's spot on. I mean, we had as an example, we had a client that, they didn't file in, like 30 different states because they felt it was an immaterial amount, right? Well, when they went to go sell their business, tax diligence, that came up, and it created a liability. The seller didn't think it was a big deal, but the buyer did. And so what they did is they made them hold back 6 figures of their proceeds in a tax liability escrow for a year. And so, that was just money that he can't touch, until they actually sort all that out in the filings in all the different states. So, affected him in a very direct way at close for something he thought was immaterial that he could have addressed a year in advance, but, just chose not to. So, yeah, it does have an impact at close if you don't think about those things ahead of time.
Mm-hmm. And if you don't file, if the plan is not to get it filed, that asker could end up sitting there for 3 or 6 years, so it's definitely, can be big dollars eventually. And maybe this one last point is that, if in certain transaction structures, if you do an asset deal, for example, and you don't file in those states, like maybe it was a $20,000 a year before, but now all of a sudden it's $200,000 in that state because you just had this giant gain that has to be apportioned there. So the actual sale process can heighten those risks.
Yeah, definitely something to keep an eye on. So it sounds like now we're kind of moving closer to that exit date, and getting the LOI signed and working through diligence and working towards a close. One question that might be kind of fairly obvious, but definitely worth talking through. And Dustin, maybe I'll kick this one over to you. Who gets to determine the value of the business? How do you know what the business is worth, and what do you do with disconnects? Like if I as a business owner think it's worth one thing, market's telling me something else, like what's going on there, and who really, it's not like selling a home where you put a for sale sign up front with a price attached to it. So how does that work, and how do you deal with differences in perceived value?
Yeah, so I mean, it's, businesses, investing in businesses are compelling to people for different reasons, right? A big, strategic, as we call them, somebody in your industry who wants to acquire you is going to acquire you for a reason different than a private equity group would be, right? So you have to understand, what are the compelling reasons someone will buy my business, and kind of be laser focused on that. So in any process, one of the things we do are, what are the key value propositions, or the key investment highlights? Why would someone want to buy your business, right? And at the end of the day, those things dictate, why people would invest in your business. And that's what really drives value. And, the market will ultimately determine that. But really, those are the things that you should be focused on. So, for instance, I've had a client who's a former investment banker, came to me and, he's like, when I asked, what are the key reasons someone would want your business? I'm glad you asked. These are the things that I've been working on my business on for the last 15 years. I knew you'd ask this question. It's these 6 or 8 things, right?
Mm-hmm.
So, I mean, that's like a dream scenario for somebody like me, because I know when the process, flushes itself out, he's gonna be able to stand behind all that, right? But the key thing is, that you want to be able to reinforce those key value propositions once you understand what they are, and prove them. So what I mean is, so we had a retail client, their, customer-centric experience, right? That's one of their key value propositions. Well, I'm pretty sure that I've never had a client say that wasn't their key reasons, right? So, people see it all the time. So, all right, easy to say, well, prove it. Well, what they did is, well, we do these 10 things different in our stores than no one else does, right? We have singers on the weekend. We have recipes handed out at the door when you walk in. They had these 10 things, right? And then to prove it, right? Well, we keep record of all of our customer feedback. We categorize it. We benchmark it against our competitors. Oh, and by the way, we keep track of every location that a customer has requested that we open a location at, and we can map it. Well, that's a lot easier to sell, that you're customer-centered, you're customer-centric, than just saying you're customer-centric and people love us, right? They reinforce it by doing those 10 different things, and they prove it by having the data to back it up, right? So something that might be a little bit more kind of, applicable to, many people kind of here in Metro Detroit is, we've had an automation client, right? And their engineering value add to what they do is second to none, they claim, right? Okay, well, again, a very hard thing to prove. So how do you prove it? Well, for the last decade, we've been tracking all of our project pursuit. We have a war room session debrief where we develop a case study on basically everything we pursued, why we won it, why we didn't. And then we take all that data and we aggregate it, right? Here are our win-loss records. Here are the projects that didn't go forward. Here are the categories we're winning in. Here's ones we're losing in, right? And here's the industry benchmarks for those type of things. And so you can very clearly see, in these 3 categories, we excel, and these are heavy engineering, type of categories. So, that's very easy to sell to an investor. And so when you're thinking about how someone's going to value your business, they're really going to value it off of what's the key reason I'm investing in this. Well, if you can understand what that is, reinforce it, and then ultimately prove it. And that's one of the biggest things in preparing for a sale, is trying to understand, what are these things that I need to prove to somebody, and start building KPIs and metrics behind it. That's where you're really going to solve the question on value, because there won't be a question of, well, how should I value this customer-centric experience? Well, I can prove it, and this is why you should value it highly, right? So.
Yeah, amount of cash flow, timing of cash flow, risk of cash flow, right?
Yeah.
So focusing on how you sell that story, I think, goes a long way on the valuation side. And so, I think another aspect of a transaction that can sometimes be daunting for business owners is when you start getting into structure and you start talking about earnouts and asset deals and stock deals and now you got to form new entities to drop assets into an LLC and all of that. So Emily, when you start hearing those strategies getting thrown around from the position of the entrepreneur, the business owner, what should your strategy be to assess that and say, all right, who's paying for this, and why is buyer coming up with this at the last minute, what seems like the last minute, to try to, is there some sort of, advantage that they're going for, and do I get to participate in that? So I guess, how do you view that from the shoes of the business owner?
Yeah, that's a very loaded question. There's a lot to unpack there. But I'd say, some of those things that you talked about would be, doing some pre-sale restructuring and things like that. Some strategies would be very, very common, especially if you've got, those advisors with you that have been through lots of transactions. They will have seen, a restructuring like a reorganization or things like that. And so they can help you kind of work through, like, is this a thing that helps me, harms me, is indifferent as a seller, and how does it affect a buyer, and how can we use this to kind of negotiate better results for me on an after-tax proceeds basis. So I think kind of having those discussions along the way with your investment banker like Dustin, with your tax advisor, to try to understand what are the goals and what are we working towards are really important. But I think it's also, different. So if you're a different structure, an S corp, a partnership, C corporation, those tax implications will be different in each of those kind of different structures, and it's important to kind of understand like what kinds of things are acceptable structures to me. They're either neutral or positive to me, or things that would be unfavorable to me. And you kind of can't take your eye off that ball, because the tax implications of a transaction can kind of vary from something like 20% to something over 50% of your deal proceeds could go to taxes. So kind of knowing, again, what those acceptable structures are and those tax implications are important. In some cases, you can kind of negotiate like a win-win. So a very common example of this would be in an S corporation that you can do either a deemed or actual asset sale. And typically an asset sale in that structure will have some costs to the sellers, either related to the character of the gain, maybe there's more ordinary income, or maybe related to where the gain is sourced to different states. But by doing that asset sale, the buyer is going to step into a much larger tax benefit. And so often what you see done is kind of what we call it a gross up, or like a payment to the seller to make them whole, so that they're kind of in the same place as if they had sold stock, but the buyer gets this great tax benefit. And so that would be like a very common kind of win-win scenario for buyers. And often, I think maybe Dustin can talk to this too, is that they're willing to pay a little bit more for a flow-through business because they're able to kind of take advantage of that step up.
Yeah, and so maybe Dustin, just real quick on that, when you start to see the items enter the purchase agreement, feels late in the stage, how do you kind of coach a seller through that? Is it, let's take a step back, make sure we understand implications here clearly, kind of lay out what any of those provisions in the purchase agreement mean to kind of get your head around it?
Yeah, so a couple things there. The first thing is when it comes to trying to figure out what, I guess, structure is going to be best for you as part of a sale. I mean, it's something you really should have an idea of before you engage with the buyer, because they're going to have a preconceived notion. They're probably going to want an asset deal so they can write up the assets. They're probably going to want a certain structure so that they can drop a C corp on it and do the section 1202 like Emily's talking about. So the important thing is to kind of have that, a plan in mind, and then understand what the difference is, right? You're never going to exactly know what the structure is going to be, ahead of time. You could, but there's a lot of different structures. So knowing in advance really helps, that conversation with the buyer, and ultimately helping, the seller understand what the implications are, right? If we go with this buyer, I'm going to have, 900K more of tax, right? How do I split the difference? Or what are some solutions where I can lower that 900? So I think the key thing there is just, that's an analysis that can be done before you engage with the buyer, and you can set the expectations with the seller. So here's kind of our decision tree if they want to go this route versus that route. But the last thing I'll say there is you should also have an attorney involved, because a stock deal comes with more liabilities or perceived or potential liabilities attached to it than an asset deal, right? So there's going to be implications within a purchase agreement, which with the liabilities that come with an asset versus stock, and so an attorney should kind of assess that on a by business basis and what that means for you as well, because you might be willing to pay a little extra tax if you can relieve yourself of certain reps and warranties on a go forward basis.
Yeah. And it may be, I agree 100%, Dustin, like kind of knowing what the structure that you're looking for or willing to do is important upfront. Sometimes I'd say like one thing that kind of comes up later or that some buyers bring and other buyers don't is like the kind of deferred proceeds either. So like rollovers, earnouts, installment notes, and those things too are, it's crucial to kind of get in front of and from the tax perspective, because sometimes you have to pay taxes on those even though you're not getting cash. And sometimes you don't. And so like kind of making sure that you are working with your buyer to kind of get to a mutually acceptable structure.
That's right.
Yeah, okay, and so I think, maybe my next question, I think we have done full hour-long discussions on, but maybe Steve, I'll kick it over to you. And when you're thinking about your team, you built this business with your team in place and everybody's kind of working hard, employees, how do you start bringing them into the fold on a potential transaction? And I know you probably could spend all day on this question, but like is there, what indicators do you look at as a good time, or along with that, is there certain tools you can put in place to kind of help motivate them through a sale process, make sure they're engaged throughout and kind of working through diligence and things like that?
Yeah, that's a great question. I think one of the, things that is always challenging, of course, is all the data that buyers are going to want to see. So, we talked about it a little bit earlier with kind of getting prepared ahead of time. So you kind of anticipating some of these things and being ready to do that. And I think really to answer the question is going to depend on how much of that work was already done. If you've been kind of thinking about it for a year and you've kind of, ideally you've brought someone in maybe to help you think about, what is the why would someone buy this business story, right? And how would I go ahead and like pitch this, so to speak? What is the story we're telling on the value that we're creating in this business and the value that the future of this business has? In a good scenario, pitching consulting a little bit, is of course, if someone comes in that understands how to use data and how to tell stories with data, and they can kind of help you kind of parse through, the comments that have come through on your website and make a story out of it and get through stuff, right? And so if you kind of done some of that pre-work a little bit, you have a better chance to kind of get there. The great part about that is it's never too late to kind of start with that kind of thing, right? So I think it really comes down to kind of the owner of the business or owners of the business, and what do they really think about the potential of the business? Is that a story worth telling? Is it this great growth story that we're trying to maximize? Is this like truly just an annuity type business that, hey, this is just someone else is buying into our annuity here? And I think kind of along that though, one of the things that is we haven't talked about yet, but I think we need to, and certainly as advisors, we all have a role in this. When we start getting into transactions, is like, what will the owners do next, right? One of the biggest reasons that deals don't go through is, they kind of get to that moment where you get kind of deep into conversations and realization hits you like, I won't be going to the office every day anymore, right? And what will I do with the 10 hours or 12 hours a day that I'm normally working? And that could be a very overwhelming, kind of thought when you get kind of right down to the moment there. And when you talk about people to involve in the conversation, certainly it's your CFO and probably your chief operating officer, VP operations kind of person, right? To kind of start these conversations because you need access to the data and you need to be able to kind of get that kind of the evidence of your success kind of in front of the buyers. But it's also, your spouse and family, right? And so if I'm not working every day, like what are we going to do with that time? Do we agree that spending, 3 years traveling the world on a yacht would be fun? Or do we need to have kind of plan B because we're not all on board with traveling a yacht for a couple of years? So I think those conversations and the other people that need to be involved are our family, right? And kind of the people that you spend time with.
That's a great point on kind of the psychology side of the transaction for the business owner. So I've got the Q&A up and have my own questions that I'm more than happy to go around and ask, but just want a reminder to the participants, if there's any questions, feel free to load those in. But we'll kind of close it out here last few minutes and kind of go around with what are some of the most common issues that kill deals? I think, Steve, that was a great one that you had just brought up. Is there anything else that you see that are kind of general pitfalls that you kind of wish you got out ahead of, or you can maybe see coming down the pipeline when you're going through a sale process?
I think the other biggest thing is just the big skeletons, right? That there is this, it could be in a lot of different areas, but it's this thing that the owner kind of knows is there and they're hoping nobody finds out through the process, right? And then, these things are usually hidden well enough that you're into due diligence for a while before you're like, there it is. And then the questions become very evasive, and the whole process of trust in the transaction breaks down, and then things disintegrate and there's just no deal, right? And it's kind of been the theme all along, is like, get the skeletons out, get them brushed off, get them cleaned up and buried, properly, so that you don't have that kind of conversation. But that's the number 2 reason I think why things fall apart is there's something big hidden, you get evasive, fully forthcoming answers, we'll say, when questioned about it kind of on the surface, and then it comes into a big thing, and then the trust goes away. And then that just spikes the general transaction risk. Like, what else do I not know about, from the seller, and what else are they hiding from me? I found this one, but what have I not found? What are they not telling me? And once that trust just disintegrates, the value in the business goes away, and certainly that transaction very rarely occurs.
Yep.
Yeah.
So Dan, I'll maybe take the next one I see a lot is, that I think, people like Dustin and those are kind of good at fighting a bit, is the deal fatigue. Like you're putting a lot of pressure on your key people. A lot of times it's your CFO and financial people, but a lot of people in the process get a lot of deal fatigue. And I've seen also where where those people aren't properly incentivized to kind of help get it over the finish line. Like, I had one time where a CFO just kind of went on vacation a week before closing. He was like, I'm done. Because they kind of not talked about any sort of deal bonus or extra compensation for him. And he knew that like he was gonna be out afterwards. And it was just kind of like, I have no reason to keep going and doing this if you're not gonna kind of help me out. So that was a very extreme example, but I do think that like, there's something to be said for making sure that your key people in this process have all the support that they need to kind of get it over the finish line, which is a very long and tiring process.
Yeah, I think Emily's spot on with that. The number one issue for sure is the people involved, right? How are they incentivized? What's their roles and all that? But that's a topic I'm sure we could talk about, our war stories for hours or days on. But I guess, to leave you with something tangible in that regard, that I would suggest is, one of the more common things is, investment bankers, is my role. We're really good at, telling stories and a growth plan and outlining it all, and it's all achievable, and, the hockey stick growth and all this. Well, a process is very long. It is very in-depth and detailed. And at the end of the day, the management team of the business has to stand behind that growth strategy. And so, eventually, if it's not a growth strategy that you really feel, convicted about, then it's going to get watered down and people are going to see through it. So the thing that I would say is probably, extremely valuable in that regard is entrepreneurs are very good about having the vision in their head, about making decisive decisions, but not necessarily about putting that down on paper. Or maybe they did 10 years ago when they started their business, and maybe they refreshed it after year 3, but now you're in year 10, and they don't think about growth in an actual documentation way. So one thing I would say is, before you do a sale, you should really take the growth strategy in your head, or out of your head, and put it on paper and define it, and get your team to buy into it, because that's ultimately what an investor is going to be buying, right? I mean, they're rarely buying a business for the annuity that it creates. They're buying it because it has growth potential, right? That's really how they can get outsized returns, and why you would buy a business. And so getting your management team to really buy into that growth strategy and having it well defined ahead of time is key. So as investment banker, part of my role is refining that, to a T, so that someone can really buy into something. But the more defined it is, at the outset, and the more bought in your team is, the much better it's going to hold up to investor scrutiny. And so.
No, that sounds great. And, just really want to thank everyone for participating today and our great panelists here. Really appreciate you all taking the time and lending your expertise. I think it was a great discussion, and to those attendees, thank you for participating today, and again to the sponsors. And I'll give a shameless plug out there for the Driving Business Value series. If anybody has any content that they want to build an event around, please reach out, let me know, and we can look at the calendar and try to get on and keep this rolling. So, with that, really, really great event today, and really appreciative to everyone involved. So thank you all.
Thank you for having us.
Thanks, everyone.